All right, welcome everybody to the webinar. Appreciate you spending some of your day with us today. My name is Clay Malcolm here at Advanta IRA, and today we're going to be talking about account types, specifically the tax advantages and certain rules that are associated with them, mostly because I have a lot of conversations with people who are looking to start a self-directed IRA, or they just want to talk about their IRA kind of situation in general. And it really is remarkable, and I've had the same experience personally. So the amount of time that people are not quite clued into or engaged in the actual tax advantages and the things that are going on, the characteristics of the account when they're thinking about investments or contributions and things like that. So I thought we would take today to just kind of review account types, their tax status, a few rules about them. So, obviously when you know the rules of the account, you can utilize it to its best benefit. So that's really what we're going to work on here today. I'm really here to answer any questions that you have as well. Hopefully I can answer them. So if you have questions along the way, please do feel free to type them into the questions box, and I will answer those after the slides. And whether it's about the account types or more broadly about self-directed IRA investing, I'm happy to answer those if I can. You will find a handout in the console of your GoToWebinar dashboard there, our self-directed IRA investing guide. Please feel free to download that. It's often a handy reference, and let's go ahead and get started. So that's me. I've been in the self-directed IRA space for about 10 years, and not only as a professional, but also as a self-directed IRA investor myself. I realized that I was kind of behind on my retirement savings, and so I started to really get into different types of investments and the ways that my account tax advantages could be utilized, hopefully to set myself up for a retirement where I'm reasonably okay from a monetary perspective. But I guess my point of saying that I am also a self-directed IRA investor is that I really do understand the pain points of the investment process, and the calculation that goes into choosing an investment and also choosing which account to have the investment in and that kind of thing. So I'm one of you as a co-self-directed IRA investor, as well as an educator and professional in the space. So if I can be of any service to you in terms of education or thought processes about how to utilize the account, that's what I'm here for. That's my contact information there. That's my direct office line and my email. So please do feel free to contact me, reach out at any time. If you have a question, I'm happy to help. And we always give this disclaimer at Advanta IRA: we do not give tax, legal, or investment advice. We don't advocate any particular investment strategy or investment vendor. We certainly encourage you to utilize your own financial team when you're doing the due diligence on any investments. And that could be your CPA, CFP, attorney, could be family members, whoever it is that makes up your financial team. You're able to utilize those folks in service of what your account is investing in. So please do feel free to do that. At Advanta, we're a very neutral part of the equation. Our job is to provide custody of the account and also to do the bookkeeping and the administration in such a way that these alternative assets that you would be investing in through Advanta are documented properly so that you get to keep the tax benefits. So our job is really to make sure that the account is in good standing so that you get to keep the tax benefits. But in terms of us giving you advice about what to buy or when to sell or those types of negotiations, that's not really our role, and we don't do that. So we're really just here to make sure that we take the strategy that you want to execute, and we try to make sure that that goes as smoothly as possible for your account to invest in that particular investment, and so that your IRA or your other account type gets to keep the returns and have the tax advantages associated with them. And one of the things about Advanta IRA that I do always stress is that we're an organization that is built for customer service. So we have long tenured employees. The company pays for us to have all kinds of continuing education. so that we are kept up to date on different legislation that goes through, and different strategies that we hear about, so that we can react and be able to service your account as best as possible. We do offer FDIC insurance on the cash position for your IRA. So that's a thing that you can, once you make a transfer in, that cash is FDIC insured. And one of the things that is different about Advanta also is you do get a two-man team here. So if you're an account holder starting an account, you get an education and business development person like myself. My job is really to give you education, talk to you about account strategies, talk to your financial team if that's something that would be helpful for you to kind of integrate this self-directed IRA idea into your overall financial strategy, and to get you onboarded. And then you also get a dedicated account manager who is in more of the kind of the back office nuts and bolts investment paperwork person. And you get that two-man team, so you have our phone numbers, you have our emails, and you always know where to go to for information. So we really are here to try to make the self-directed IRA investment experience go as smoothly as possible, and for you to understand it as best as possible. And when I refer to self-directed IRA investment process, I do want to be specific about what it is that we do in the kind of the context of the entire space. So we are a plan provider, and we provide all these types of accounts. So traditional Roth, HSAs, SEP IRAs, simple IRAs, solo 401ks, education savings accounts. All of those account types can invest in alternative assets. And by alternative, I mean things like physical real estate, physical gold, private equity, private lending, cryptocurrency, things like that. So the core concept of what we do at Advanta IRA is combine the tax advantages of these account types, and the account types don't change. Self-directed IRA is not an account type. It's really, self-directed is really just a descriptive term, and it talks about the fact that your IRA, as the account holder, are going to have some choices in terms of the assets that your account invests in. But it is not a legal distinction. It's not an IRS account type. It's really just a descriptive term meant to indicate that you as the account holder are going to be a little bit more active in terms of the participation in choosing assets and that kind of thing. So the combination that we're going to talk about today, and the account types, obviously we're going to focus on the account types, but the overall strategy is combining the tax advantages of those account types with alternative assets. And the reason that that's important, I think, is because, first of all, it gives you a very different way and more powerful way to diversify. You certainly get a chance to exercise your own expertise. If you have an expertise in a particular asset class, or your financial team has an expertise in a particular asset class, you can actually take advantage of that. You might even have some private information. Somebody who has a private company that's looking for investors, things like that. So this ability to have your tax advantaged account invest in something other than publicly traded assets like Wall Street stocks and mutual funds and things like that can really mean that those accounts grow faster, assuming that the investment is a good one. And it always boils down to that. Let's not kid ourselves. You always have to make a great choice in terms of what you invest in, which is why we always encourage you to talk to your financial team about due diligence. But the ability for your IRA to be able to get into investments that you might feel more comfortable with or might produce better returns is certainly something that we really feel proud of in terms of our business model, because we are here again to keep the account in good status, keep your account in good status so that it can invest in these alternative assets. And permissible assets really is a very large set of stuff. So really only collectibles and life insurance are prohibited. And so all of these things like real estate, again, private lending, private equity, precious metals, all these kinds of things, almost anything that you know how to make money at outside of your IRA, you can make money at inside your IRA, as long as you take the time to set it up properly. And a couple of things to talk about in terms of account types too. I do want to mention that The IRS will let you have multiple IRAs operating simultaneously, and they can be either the same account types or different ones. So I have, let's see, I think 2 traditionals, a simple, 2 Roths, 2 HSAs, and a 401k at the moment. I went a little overboard. I understand that, but the fact is you can have multiple traditional IRAs running. You can have a traditional and a Roth running simultaneously because each one has different properties. You might be able to utilize that in a specific way. And one of the reasons why you might choose to have 2 traditional IRAs or 2 Roth IRAs is it's very common for us to have account holders who also have that same account type at a bank or brokerage house. And what that allows is for your IRA money, one account at Advanta, one at a bank or brokerage house, to be operating simultaneously in 2 different realms of investment, right? So the bank or brokerage house, typically their IRAs are limited to publicly traded securities. So they're a very efficient way for your IRA to invest in those publicly traded securities. However, Advanta is not. We don't do publicly traded securities very efficiently. So our idea, our role is to give you access to alternatives. So if you wanted to own a piece of real estate and have some stocks, both in a traditional IRA or both in a Roth IRA, you might have 2 operating simultaneously at 2 different custodians, because the custodians actually determine which assets are going to be available for that IRA. The IRS does not say to custodians, hey, if you're going to be an IRA custodian, you have to handle every asset that's allowed by law. They don't say that. The IRS says these are the rules for being a custodian, and then you, Mr. Custodian, build a business model around it. So banks and brokerage houses, their model is, hey, we'll be the custodian for your IRA, but while it's with us, it can only invest in the things that we do, which is publicly traded securities. And at Advanta, we kind of take the opposite end, which is, hey, we'll be the custodian of your IRA, and we will specialize in the bookkeeping and the administration for accounts that invest in alternatives. So you bring us the investment that you want, we'll help you document it properly so that you get to keep the tax advantages. So a lot of people will ask me, well, what's the difference between Advanta IRAs, and my IRA at Schwab? Well, generally speaking, it's what you can invest in. That's really the difference. But the accounts themselves are the same: traditional, Roth, SEP, simple, etc. Those account types that we talked about. All right, let's talk a little bit about the IRS's mindset, scary place that it might be. So, and these are just concepts that kind of help you understand what's happening in your account and how that might affect your strategy. So IRAs are taxed differently than a person or a company, right? They have special tax advantages, and so because they do, the IRS is going to, obviously, if the tax event is different, they want to make sure that that money that is a part of the account is separate so that they can apply that tax status only to that money. Same with an individual, same with the company. That's why you as an individual have a Social Security number or a tax ID number. Companies have tax ID numbers. And in fact, your IRA is a legal and financial entity itself. And it has a different tax ID number, has a different name, and it has a different bank account than you do personally. So my personal funds is under the name Clay Malcolm, of course, but my IRA is Advanta IRA FBO Clay Malcolm IRA, or Roth IRA. That is actually the name of my IRA. That IRA has its own bank account, has a cash position at Advanta, has its own tax ID number, separate from my Social Security number. So it is a legal and financial entity that can go out into the world and invest, buy and sell, make money within the shelter, the tax shelter that is the account type. So again, the IRS wants to track this activity, both it's going to track contributions, it's going to track distributions, and it's also going to track, to some extent, the activity of the account, that money while it's in the account. And that's one of the reasons why they require a custodian. So an IRS is a little trust, right? It's operating as a trust on your behalf, and this trust has specific tax advantages. So because the IRS wants to track that money, it requires a custodian. And we are regulated by state banking authorities, so we have rules that we have to follow, but understand that we are part of the system that tracks this money. which is one of the reasons why you can ask us about, is this a prohibited transaction or things like that. We specialize in understanding the rules for the accounts. So do understand that the IRS is looking to track the money, and this is why you can't just have an IRA that you're the custodian for, right? The IRS requires an official custodian for any IRA, whether it's us or Schwab or Fidelity or a bank or whatever. And understand this too, that traditional IRAs and Roth IRAs and HSAs, and I'm gonna keep throwing that in as we go through here, they all have different account statuses, and they all have different contribution rules and distribution rules, right? So because each of those are separate, those are also have to be kept separately. So you can have a traditional IRA and a Roth IRA, but they're accounted for and documented completely separately. And even though they're both attributed to you as the account holder, well, the reason for that is because they have a different tax status. And so the IRS wants to make sure that line of tracking that they have is separate for each of them, because the taxes are going to be applied differently, right? And understand this, and I know I keep harping on this, but the account types are the determiners for contribution rule, basically contribution rules, distribution rules, and the account status, the tax status. So those are the three main characteristics that you're looking for when you're looking at a particular account type. So just the same way as I pointed out that IRA custodians are essentially the key to which type of assets that money can invest in, the account type that you choose at that custodian is going to determine contribution rules, distribution rules, and the tax status. And looking at these accounts from a general perspective first, I will just say this, that what's happening here is you're making contributions from your personal money and you are putting it into this account. And at that time, when you make a contribution, a qualified contribution, you are changing the tax status of that particular money. So something has happened. It's going to go into this little trust, which is an IRA, and it's going to be taxed differently than you personally. So when you make a contribution, understand you are changing the tax status of that money. Now, for all of these accounts, the status of the earnings, in other words, the money that contributed money makes, is tax deferred. And the reason that this is considered to be so important for most financial professionals is the fact that your earnings can come back tax deferred means that the entire amount can then be reinvested. And what that allows for is this money to compound faster. And so one of the great gets of all these account types, traditional, Roth, HSA, all of them, is that because the earnings that money makes come back to the IRA or the account tax deferred, the whole amount can then be invested, right? So let's say that my IRA buys a condo for $80,000, and a couple years later, my IRA is able to sell that condo for $100,000. So, first of all, good for me and my real estate team, they did well. But second of all, the entire $100,000 would come back into my IRA and then could be redeployed into another real estate investment or stocks or cryptocurrency or whatever it is that I want to invest in. And if I had done that personally, that $20,000 of gain would have been taxed. So I would not have had the entire $100,000 to reinvest. And I know that can seem like a kind of a small distinction, but if you've ever looked at any of those tables that talk about the idea of compounding effect, it really is remarkable how if the more that you can preserve of the earnings that you create, the more powerful the account becomes, right? So that's why I have the addition of time. So especially for those of you who are a little bit younger than I am, and shoot, we're all living a lot longer. So using time to your advantage and using this account type that allows for those earnings to be tax deferred and therefore compound faster, that's a gigantic boon for a financial strategy, right? So that really is the idea that's behind these accounts and creating some wealth or at least creating some savings that we can rely on when we're, in our retirement years. Now, I mentioned the fact that there are tax statuses that are associated with these account types, and I want to just talk about what those are because I'm going to use shorthand of traditional, Roth, and HSA throughout this presentation. But do understand that there are account types that have these statuses that I'm not going to name every time. So the traditional tax status, meaning pre-tax money in, tax deferred while it's in there, and then the tax event is at the time of distribution, and we're going to talk about that in a moment. Those account types that have that are the traditional IRA, a SEP IRA, which is simplified employee pension, a simple IRA, usually for small companies under 100 employees, and then qualified plans. And by that, I mean 401ks, 403bs, 457s, those account types, those plan types all have traditional tax status, right? So there's a tax, what I mean by tax status is a sequence of events with the tax event being at the end. I'm going to show you that in a minute. Now, Roth flips the script, meaning that the tax event is at the beginning. So for those, that's a Roth IRA. And some of these qualified plans that I mentioned, particularly 401ks, can have a Roth component to them. And without going too far into the weeds there, understand that it is the plan document for a 401k or a 401a or 403b or whatever it is that would determine whether Roth contributions or Roth style money, Roth tax status money is allowed in that plan. So some of them do and some of them don't. So if you do have any questions about the plan you're in, call the plan administrator and ask them if there's a Roth component to that plan. Again, some of them do, some of them don't, and it's according to the document that runs that plan. And then HSA status, well, HSA is in a league of its own because essentially it can be tax-free money when it's operated properly. So, and we'll talk about that a little bit shorter because many of you won't qualify for an HSA, but I'll let you know how it works so that you have a sense of it because it is such a powerful tax tool. But usually what we're going to be talking about is the traditional IRA tax status, the Roth tax status, and then HSA, as I say, is kind of in a world of its own. So remember that from a basic standpoint, this is what we're talking about, is where is the tax event in the investment sequence, right? So again, I took our three categories there, traditional, Roth, and HSA. At contribution, there's no tax event for traditional. So it is considered to be pre-tax money in. And the mechanics of that are this. You can either have money deducted from your paycheck by your employer if they do that, and it's before taxes are taken out, right? So it actually reduces your income when you go to file your 1040. So you can have that money deducted from your pay ahead of any kind of tax event or it even being called earnings. Those can be taken out and put into a plan if the employer offers that. So traditional money is pre-tax status. Now, if you don't have the money deducted from your paycheck, that means that when you go to file your 1040, whatever your contribution amount is, that becomes a deduction on your taxes. So again, the net effect of that is that it's pre-tax money. It has not been taxed yet, right? So you earned $1 and $1 got contributed to your traditional IRA or those other account types. Now, I will say this, that if you can have your employer deduct the plan and deduct the money and it goes into a plan, that has an additional benefit of the Social Security tax never gets paid on that money either, right? It comes right off the top of your earnings, your gross earnings. So that's something to keep in mind as well. So if you have the option to have your, let's say your 401k contributions deducted from your pay, that's where it gets the most tax bang for its buck. So $1 earned is $1 contributed. Now, a Roth, on the other hand, is post-tax money when it's contributed, meaning that the taxes have already been taken out. So if I earned $1 and my tax rate was 25%, then really what I'm contributing is 75 cents of the dollar that I earned because taxes have already been taken out. So it is post-tax money in. So you can see the asterisk there indicates that there was a tax on that money. HSAs are pre-tax money similar to a traditional IRA. Now, in the earning phase, so we've made contributions, the money is in those accounts, and when it's earning, all of them are tax deferred. And that's that phenomenon that we were talking about earlier, where I buy the real estate, it makes some money, I sell it for a profit, the entire profit comes back, and I'm not, I can redeploy that entire amount that I earned on that money. Okay, so all three accounts have that. Now, at distribution time, this is where traditional and Roth, as you can see, the tax event has flipped. So traditional was the money has not been taxed at the time of contribution. It doesn't get taxed in the middle where it's earning, but it does get taxed at the end. And the idea being, theoretically, that when you are making contributions to your traditional IRA, you probably in your earning prime, and therefore your income tax percentage, your bracket, would be higher, presumably, than at distribution time. So let's say that you're now working part-time or not working at all. Well, it's possible that your income tax bracket will be quite a bit less. So let's say if your income tax bracket was 25% when you were making contributions, first of all, that was awesome because you got a deduction for that money at that time, which you needed. And then let's say that your income tax rate at distribution time is 10% or 15%. Well, that means that the taxation rate on the money that you're taking out is less, right? So this is one of the additional effects or tax advantages that the account has. Now that assumes that your income tax rate at distribution time is is less than when you made the contribution. And is it possible that that wouldn't be so? Yes, it is possible. The government could change income tax rates. You could have won the lottery and you might be in the highest tax bracket ever at distribution time. Who knows? But conceptually and historically for a lot of people, that's really what happens. Your income tax rate is lower when you're taking distributions later on in life, and so the rate at which that money is taxed is less. But understand this: the distribution on a traditional IRA in that tax status is whatever the gross amount of the distribution is, that gets taxed at your income tax rate at the year of distribution. Right? So whatever your income tax rate is during that year that you take the distribution. So Roth, on the other hand, as long as it is a qualified distribution from a Roth, is tax-free. So one of the analogies that I often hear is that traditional IRA is taxed on the fruit of the tree, whereas the Roth IRA is taxed on the seed money that you put, assuming we're talking about a tree. So different timing and different rules for distributions as well as the contributions. And people often say, well, is one better than the other? Well, no, not necessarily. If you're looking at it from which account type will produce the least amount of taxes on a complete investment sequence, the answer is the account. There's not a pat answer. It depends on what the account investment sequence look like, right? And what was your income tax rate at contribution time? What was your income tax rate at distribution time? Now we are going to talk about some times when Roth accounts tend to be more favorable from an account from a tax status, and we'll get to that in a little bit. But is one account better than the other just in and of itself? No, that's not the case. Okay. And then HSAs, I put there just to show the fact that there can be no tax event for HSAs. So it's pre-tax money in, it's tax deferred while the money is in the account, and at distribution time, again, assuming you take a qualified distribution, which means that it was for a qualified medical expense, it is also not taxed on the way out. So it's literally tax-free money. So if you have an HSA, I encourage you to make contributions, even if you leave it in the HSA for a day. Let's say you make an HSA contribution on Wednesday, you go to the doctor on Thursday and you pay the doctor's bill out of your HSA, you automatically save the percentage on that bill that is equivalent to your income tax rate. It's a remarkable tax tool. Again, not everybody is eligible for it, but it's a remarkable tax tool. So just by comparison, I put it there. Okay, I mentioned the fact that all these account types have contribution limits. I put up the year 2020 ones here because for a lot of these accounts, you can still be making 2020 contributions. And as you may have heard, the tax filing date for this for tax year 2020 has now been pushed off to May 17th. So it's not a typical tax day in April, so it's off in May. I have not heard the official guidance yet that you can still be making contributions into May yet, but I think that there's an anticipation that that will happen, but I do not know that for a fact at the moment of this recording. But anyway, I used 2020 contribution limits, and really this is just any tax year that you're contributing for. Look up what the tax contribution limits are, talk to your CPA or whoever it is that is your tax person, and remember to just find out what it is so that you don't over contribute. But each of these account types will have some sort of limit for new money in, and that's really what the contributions are, is new money being introduced into the plan. So just be aware that they exist, look them up. This is, again, your 2020 list. 2021 is slightly different for some of these account types, so please do check as you are making contributions. And then, all throughout this presentation, I'm going to try to address some misconceptions that I see or hear when I'm talking to account holders. And one of them is that because there are annual contribution limits, every once in a while that gets conflated with earnings. So I want to just say this, that contributions and earnings, they are not the same thing. So contributions is new money in, and it is limited, and it's limited according to the account type. So you will have some limitations about how much new money you can put in. That is not the same as the earnings. Earnings are the amount of money that the already contributed money makes. There's no limit on earnings. Your IRA could make $1 million in a year. There's no limit to that. And understand this too, that your IRA only interacts with your personal tax world in a couple of times. Usually it could be interacting at the time of contribution, it could be interacting at the time of distribution, or it could be interacting if you make a traditional to Roth conversion. But if none of those events are happening in a given tax year, your IRA could make $1 million or lose $1 million, unfortunately. And I can attest to the fact that IRA investments can lose money. I've had that experience more than I care to share. But the earnings, the operations of that account, what happens inside the account, it doesn't affect my personal taxes in that tax year at all, right? So it can make $1 million, lose $1 million, doesn't matter because it's all separate from my personal finances. So there are only certain times when my IRA's finances interact with my personal finances. But the point of this slide, I'm digressing a little bit. The point of this slide is do not confuse the annual contribution limit with the fact that your earnings, that the contributions that are already in there can make an unlimited amount of money. Okay. Now, I've talked to account holders sometimes about contribution strategy. And the reason that I do that is because these are for folks typically who have multiple accounts. So just thinking about the account types and where they sit in the hierarchy of taxes and things like that, it could determine where you allocate contribution dollars. Listen, not all of us can make the max contribution to all these accounts. I have tax years all the time when I can't and don't. So thinking about when do I make contributions and if so, where do I do it is an important thing, right? So this is one that I've seen as a model that I think at least introduces the concept. So they will say to me, well, I will ask them, why do you contribute to your 401k or your simple IRA first? And they will say, well, because in those two account types, it's a very common thing for there to be employer matching. And so the person will make a contribution into their 401k or their simple IRA up to the amount that the employer is going to match because they just doubled their money. The employer is going to match it. So it's money that you wouldn't get otherwise unless you make the contribution. So notwithstanding the tax advantage part of it, doubling your money right off the bat is a good thing. So thinking about anytime you have an account that has employer matching, to go ahead and utilize that makes a lot of sense, right? Then I see some people who will go immediately into their HSA if they're eligible to have one, and they do that because it has the best tax benefits. And again, I'm just going to sketch HSAs today. We do webinars on on HSAs. They're an amazing tax tool, but they are relatively, there are a lot of details to it. And I don't want to, go down that path today. But if you have questions about your HSA or the benefits, you can always call me, or our YouTube channel has videos on HSA as well. But because sometimes people see the HSA as best tax benefits, that will be the next pool that they will make their contributions. And then when they hit the maximum of that, they will often go back to their 401k or other type of IRA. And then, sometimes they will also then go to their Roth IRA, because you can max out your 401k contributions. And then, assuming that you don't exceed the income limit, you could still make contributions to your Roth. So the fact that the Roth IRA has the ability to perhaps get more money into a tax advantaged account in the same tax year will be a reason to add that on to the end of the of your contribution allocation. Again, I'm going through this very quickly, and this is a generalization. Your personal financial world is going to have a lot to do with how and which account type you contribute to. So do consult your CPA or your tax person or your financial person to find out what the best sequence of contributions is for you. I mentioned earlier that there was an ability of you to have multiple IRAs operating simultaneously. Well, the fact is you can also move money around quite a bit too. So this is a rollover chart directly from the IRS website. You can see that the left-hand column is roll from accounts, and the rollover chart is on the top. The row on the top is roll to, and you can see there's a lot of yeses there. So a lot of these accounts can be consolidated or moved. And part of the reason that I mention this is because sometimes when people come to Advanta because they want to invest in alternatives, sometimes those alternative investments have a higher investment threshold. I'm going to buy a piece of real estate. Well, I might need more than $4,000 to do that. And so one of the things that I see very commonly is somebody will open an IRA with Advanta. They'll do a rollover from an old 401k, say where they're no longer employed, something like that. And then they'll also move over some of their traditional IRA or a SEP IRA that they had, or a 457, something like that. So sometimes you can combine these plans as well. So understand that you can have multiples operating simultaneously, and that you can often move them around to position them where you want them for the best effect of the investment. And again, when I talk about best effect, in a lot of cases, I'm talking about, hey, do you want to be in an alternative investment in addition to or instead of a Wall Street product? So understand that you have some flexibility in terms of moving the account dollars as well. Okay, so let's go through traditional IRA, then we're going to go through Roth, and then we're going to go through HSA, and there'll be some little pieces in this, in each of these in terms of strategies and things like that. But I do want to give you the overall understanding. So we talked about the high level, where's the tax event, how does that work? So understand that anybody with earned income is eligible to contribute to a traditional IRA, but you do have to have at least as much earned income as the amount that you're going to contribute. The deductibility may be limited based on your annual income, as well as other accounts that you are contributing to. So do understand that some traditional IRA contributions are not pre-tax. You can put post-tax money into a traditional, and that may be a good use of your money. Again, talk to your tax person about that. But the cool thing about it is, when you make a regular traditional IRA contribution, you usually get a tax deduction, so that lowers your current tax bill, hopefully. You get the tax deferred growth. And as I mentioned before, former 401k is also usually a traditional IRA status, so those could be combined. And this is really, a way to help you save for retirement, of course. Now, understand that there's a time sequence to the contributions and distributions and things like that. If you are under 15, so when we talk about distribution rules for traditionals, if you're under 59.5 and you don't meet one of the specific other requirements or exceptions, there's a 10% early withdrawal penalty. So not only would your distribution be taxed at the income tax rate that you are at that time of distribution, but you would also get a 10% penalty. After you are 59 and a half, obviously there's no tax, there's no penalty. That 10% penalty goes away at 59 and a half. 72 is now the age for required minimum distributions. It used to be 70 and a half, now it's going to be 72. And what that means is that the IRS has let you, in a traditional IRA, has let you have that money be active and investing and creating new money, hopefully, for some period of time, but the IRS has not gotten to tax it yet, so they're freaking out. They want their tax money. And so at 72, you have to start taking distributions, at least a portion of it, right? So it's a fractional piece starting at age 72 and a fractional piece each year thereafter, and they're called required minimum distributions. Now you can take more than the required minimum distribution in a given year. You just can't take less. Well, you can, you just get penalized. And the penalty is, I think, 50% or something. It's outrageous. Okay. You can also take distributions with some exceptions that mitigate the 10% penalty. So higher education expenses, disability, first-time home buyer. I actually use this myself. The first house I ever bought, I made almost the entire down payment from a distribution from my traditional IRA. It was taxed, but it was not penalized at 10% because it met one of these exceptions. And then inherited IRAs. So inherited IRAs have a different distribution strategy. And again, it's a little bit lengthy to talk about, so we probably will, if you have questions, just let me know. If you are a beneficiary that is the spouse, generally speaking, what you can do is just take that IRA as your own, and it then follows those rules because it is now yours. If you are a beneficiary and you are not a spouse, then the IRA at this point has to be distributed within 10 years, and there is some variability in that too, so do understand that. So again, from a timeline sketch here, just for your conceptualization, before 59 and a half, there's a 10% early distribution penalty, unless it's for one of the exceptions. Between 59 and a half and 72, you as the account holder can have complete control over distributions. So you could take all of the money out as distributions, you could take none of it out, you could take some of it out. So there's no 10% penalty, there's no required minimum distributions or no required distributions at all. So you're in control there. At 72, that's when the required minimum distributions start to kick in. All right, Roth, the kind of the counter to that. So you have to have earned income, and anybody who has earned income, as long as the earned income is not above a certain threshold, you can make a contribution to the Roth. Again, it's post-tax money in, but the earnings are tax-free, and as long as it's a qualified distribution, there's no tax on the withdrawals. There's no mandatory withdrawals. And going back to the IRS's mindset, I mentioned the fact that with traditional IRA money, the IRS is getting antsy. They want to tax that money, and so that's why they have RMDs, because they want to start getting some tax money. Well, with a Roth, they're assuming that they've already gotten their tax money, and that's why you don't have to have required minimum distributions for a Roth. The Roth component to a 401k is a little bit different because it does have RMDs. So if you're talking about not a Roth IRA, but a Roth component to a 401k, understand that rule is a little bit different. But generally speaking, in Roth IRAs, there's no required minimum distributions because the IRS already has their tax money. So again, if it's the account type that you prefer or that you have, those are going to be the rules. And what that does is it gives you a little bit more control over the distributions. Another misconception that I have with the annual contribution limits that I like to just point out is, again, please don't confuse contributions with conversions. So yes, there are annual contribution limits, and they're set by the account type. Conversion rules, they're at the moment, and this was not always the case, and it may not always be the case, but at the moment, there's no limit to how much you can convert from a traditional to a Roth. And a traditional to Roth conversion is essentially changing tax statuses midstream. So you're taking that quote unquote pre-tax money that was the traditional, and you're going to pay the tax rate on it at the time of the conversion. And what that means is that whatever the gross amount that you convert in a given tax year, let's say it's $20,000, $20,000 is going to be added to your income in the tax year that you make the conversion. So it'll be taxed at your income tax rate in that year. But then as long as you maintain the 5-year waiting period and you make a qualified distribution at some later date, all of that money that you converted plus its earnings, again, as long as it's qualified distribution, will be tax-free. So you've changed that money status from the traditional status to the Roth status by virtue of paying the tax at a given date. And then, again, as long as you meet the qualified distribution criteria, it will be tax-free thereafter. And again, no limit on conversion amounts at the moment. So if you had $2 million in a traditional IRA and you wanted to convert it to Roth, you could. Now, $2 million would go on your income for that tax year. So you might have that to wrestle with, but understand that there's not a limit to it at the moment. And I already talked about what a conversion is, kind of defined it. I got a little out of sequence there. But you are changing that money from pre-tax money to post-tax money, and going forward, again, assuming a qualified distribution that's tax-free. So why would people do this, right? So there's a few reasons. In some cases, people they make too much money to contribute to a Roth, and so sometimes they will contribute to a traditional or other account type like a SEP or simple or something like that, which is the traditional IRA format, and then they will convert it. Because again, there might be some limits to the contributions that you make, but there aren't to the conversions at the moment. So everyone is eligible to convert. The income limitations that apply to making a Roth contributions do not apply to making a traditional to Roth conversion. So it's quite a bit different. So again, contributions and conversions are different animals. So understand that. And then why? So I mentioned earlier that I would talk a little bit about why sometimes Roth can provide a tax burden on an investment sequence that is overall less. And these are some reasons why people tell me that they've seen this. So sometimes people will make a conversion in a year where they had a personal loss on another asset. So they have either a tax credit or some sort of loss to offset the conversion amount. So that is a reason to maybe convert in a given tax year. And what that does then, again, is eliminate taxes later, right? If you're expecting higher taxes in the future, let's say you just really firmly believe that the government is going to raise income tax rates across the board from here and forevermore, then maybe it is a better idea to pay a conversion amount now than it would be later. And let's say you have a long time before retirement. Sometimes this will be a good reason for people to make a conversion or simply open a Roth and contribute to a Roth. And part of the reason for that is that the more time that you have, that means the more potential tax events that you are avoiding by having the money in a Roth, right? So more earning events and things like that mean that that's more taxes that you're not paying. So sometimes that longer time frame means that the Roth will create a better overall tax burden, a lesser tax burden on an investment sequence, because just by virtue of the amount of times that another investment might be taxed. I've certainly seen people make conversions when the assets have a depressed value. So especially when you're talking about hard assets like, let's say, gold or platinum or something, or a piece of real estate, if there's a dip in the market and the value goes down, you can convert those hard assets from traditional to Roth at the depressed value, right? So it's the value at the time of the conversion. So if you have a hard asset and it's got a low value and you want to convert it while it's at the low point, you can do that, because then when it rises again and you sell it, it's in the Roth format and it's tax-free, again, assuming a qualified distribution. You do have to have the ability to pay tax that's due on conversions, so understand that. Conversions, sometimes people do this when there's a potential for a very large or outsized return on a small investment amount. I certainly hear this in conjunction with some people when they're thinking about cryptocurrency. Sometimes they just know a company that's going to explode or going to go public or something like that, and they feel like their very small investment amount could possibly end up being a very large amount. And in that case, because of the ability to eventually have the earnings be tax-free, that potential, that would mean that in a lot of cases, a Roth would create less overall taxes than a traditional. So a home run type investment is another reason that sometimes people use a Roth rather than a traditional. And if you don't have any money in a Roth format, and you know you're going to invest in a home run swing, so to speak, sometimes people will make a conversion ahead of time so that the investment is in a Roth just in case it does actually make a ton of money. And then the other is generational wealth. So I mentioned the fact that one of the things about having money in a Roth format is that there's no requirement of distributions. Well, requirement of distributions obviously are going to mean that the account balance is going down at the end of your life after 72. And because a Roth doesn't have that, that means that if you end up not having to use your IRA money for your own living expenses, and you want to pass it down to the next generation or to anybody for that matter, you can do that. And in the case of a Roth, you don't necessarily have to deplete the account as you get older because it doesn't have requirement of distributions. So that's one of the reasons why people do that. And that's not a very good graphic, but this just illustrates that. So if this is your IRA's value and you hit age 59, and you might start taking distributions at that time because of the elimination of the 10% penalty. But if you don't convert at some point at 72 there, you're probably going to start depleting the amount that's in the account. Whereas if you do a conversion or it's in a Roth to begin with, you might be able to keep that account growing over time and be able to pass it down to your heirs. So this is a generational wealth thing that I've seen from a lot of account holders, if they can do it. And we talked about that. Okay, so Roth distribution rules are more complex, I think, in some ways than traditional. So I'll just understand this. There is a 10% early withdrawal penalty if you're under 59.5. The general rule for completely tax-free distributions, qualified distributions from a Roth, is the Roth has to be open for at least 5 years, and you have to be over 59.5. Right? So those are the two general basic criteria. There are the same exceptions for a Roth distribution as there are for a traditional, so higher education, disability, first-time home buyer. And Roth distributions go in a particular order. So it is contributions are distributed first, and an annual contribution that you make to a Roth can actually be taken out of the Roth, meaning, so let's say that the annual contribution limit for 2020 is $6,000 if you're under 50 years old and $7,000 if you're over. So let's say you make a $6,000 contribution. It's post-tax money. So the IRS is actually going to let you take distribution of that $6,000 without tax and without penalty at any time you want, because they've already gotten their tax money out of it. So again, going back to the IRS's mindset. Now, if that $6,000 has already made some money, the earnings that $6,000 made don't have that same status. You can't just take that out anytime you want. That has to meet the criteria of the account has to be open for at least 5 years. You have to be over 59.5 for that to be tax-free. And then understand this too, that conversions, because they are changing tax status from traditional to Roth, each conversion amount has a new 5-year clock that starts when you make the conversion. So in order to take a distribution tax-free of the conversion amount plus whatever money it makes, it's 5 years after the conversion, plus you need to be over 59.5. So Roth distribution rules are a little bit more complex in as much as there's some gradations and they have a sequence to them. So again, I would always encourage you to talk to your tax person when you're thinking about taking a distribution, especially if you're under 59.5, but even if you're over 59.5, thinking about when did you make the contributions, what's going to be tax-free, are you certain that it's going to be tax-free, et cetera, et cetera. All right, I'm going to spend a couple minutes on HSAs, then I'm going to have answer some questions, and I realize I'm running a little short on time, so I'm going to go through this a little bit quickly. HSAs are remarkable in as much as the tax status on them is pre-tax money in like a traditional, tax deferred in the middle, as I mentioned, all the account types are, and then tax-free taken as a qualified, as long as the distribution is taken to match a qualified medical expense. So it's tax-free money. And frankly, if you make contributions to your HSA and then invest the HSA, which you can do, the earnings that the contributed HSA money makes never gets taxed. So it is actually as close to free money as you're ever going to see. Like, it's money that was not taxed when you put it in. It made some money, and you get to have that money tax-free as well. I mean, it really is remarkable in terms of its tax status. Now, there's a few things about it, and I'm going to get to the criteria here in a moment for if you can have an HSA. HSAs are not use it or lose it like a flex spending account. It is a individual custodial account, and it operates very much like an IRA. So it can invest in alternatives. It does persist through time. So once you've made contributions, that account will be open until you take full distribution of everything that's in it, right? And it is portable. Doesn't matter if the account was set up by your employer. It doesn't matter who makes the contributions. Anybody can contribute to your HSA. Your employer might do that as a way to, appreciate you as an employee. It doesn't matter where the contributions come from. It doesn't have to be earned income. So HSA contributions are a little bit different as well. It is an individual portable account. You can have multiple accounts operating simultaneously. I have an HSA at a place that's more like a bank, so I have a debit card and all that kind of stuff for medical expenses that I might need. But I also have an HSA that for my self-directed investments at Advanta, because I want to be able to have any money that I don't think I'm going to need right away be making more money, all of which can be distributed tax-free. I mean, it's just remarkable. So understand that is possible. So having multiple HSAs operating simultaneously is also a way to maximize the HSA. To qualify for one, you have to have a high deductible health plan. You can't be enrolled in Medicare, and you can't be claimed or listed as someone else's dependent. You also can't have first dollar healthcare coverage except for very specific things. So these are the criteria for having an HSA to begin with. And the foremost of that is a high deductible health plan. If you don't have a high deductible health plan, you're not eligible to open an HSA. And so the reason I bring this up is because high deductible health plans are becoming much more popular because, for some, the premiums are less. So in any event, you have to have a high deductible health plan, no first dollar health coverage except for specific type things like vision and dental, can't be enrolled in Medicare, and can't be claimed as a dependent. So those are the criteria for having an HSA. So I realize that eliminates some of you guys. Understand this too. Distributions are not necessarily tied to your age. Distributions can be taken at any point that you incur a qualified medical expense, either on the day of the expense or any time thereafter. And so you don't actually have to reimburse yourself for the qualified medical expense. There's an investment strategy here that can be utilized, which is that if you don't reimburse yourself for the qualified medical expense right away, but keep it in the HSA and keep it invested so that it's creating more HSA money, you have the ability to pay more bills tax-free with it, more medical bills. So again, for more information about HSAs, check out our YouTube channel or give me a call. I'm happy to talk about it. I kind of geek out on HSAs sometimes. And the other thing I wanted to make is that qualified medical expenses, meaning an expense that allows you to take a tax-free distribution from your HSA, that is an enormous set of stuff, right? It's not just Schedule A medical expenses. It's also dental, vision, almost anything that a doctor would prescribe to you. I mean, it is remarkable how many things that are considered as qualified medical expenses. So the idea that you would not be able to find a qualified medical expense to take a distribution, I mean, you'd have to work hard. I will also say that HSAs, if you do have an HSA and you don't think you'll ever need it for any qualified medical expenses, at age 65, you can start taking distributions for things that are not qualified medical expenses. Now, you do get taxed, so it becomes essentially like a traditional IRA, but you don't get penalized. If you take a distribution from an HSA for something other than a qualified medical expense before you are 65 years old, it's not just a 10% penalty, it's a 20% penalty. But again, the idea that you would not be able to find some sort of qualified medical expense, it's at this point it's unlikely. I mean, it's there's a lot of things that are qualified medical expenses. Okay, so I'm gonna come back out of that rabbit hole. All right, so I hope that this information was helpful for you. I realize that I'm at 1 hour here, so I'm gonna just, if it's time for you to go about the rest of your day, I really appreciate you spending some time with us. I hope it was helpful. We do have a learning center and a lot of learning resources. So events like this, the webinar series, we do have a video library that's on YouTube. Our blog is very good about posting blogs on events that are happening, especially new legislation and things like that. So please check out our website to access the video library or the blog or our events. Remember that getting started on a self-directed IRA is relatively easy. You just open an account with us. You get some money into that account via transfer, rollover, or contribution. Transfers and rollovers obviously coming from other accounts. Those two activities are done properly, are not taxed and not penalized. Again, you're just opening up a different IRA all under the same tax status. And then once your Advanta account has some money, you're ready to start investing, and we're happy to help you with the documentation of whatever investment you choose there. We also do have an investors marketplace and forum. So we do it every other Friday. The next one is this Friday. So it's free, there's no obligation. If you are an investor and you're looking for investments, you can come and introduce yourself and say what you're looking for. If you're an investment issuer, or your IRA owns, let's say, a piece of property and you're trying to sell it, you can come onto this forum and say, hey, I have a property, I'm trying to sell it. Here's some details about it. Here's my contact information, et cetera, et cetera. So it is a place for investors and investment issuers to network. We do not advocate any particular investment or investment vendor. We don't vet anybody who's going to be on this. So it really is, it's your due diligence once again. All we're really doing is providing a forum, and investors and investment providers can meet each other there and start the process of due diligence and vetting each other and finding out whether there's a match there. So please feel free to avail yourself of that. And here's my contact information again. Really, I'm happy to talk to you about this stuff. I want you to do it right. And, so please do consider me a resource. If you'd like me to speak with your CPA or your financial person, I'm happy to do that as well. So understand that that's a resource for you as well. Okay, I'm going to take some questions. So if you have not typed in your questions in the question box, please go ahead and do that now, and I will try to get to all of these in relatively short order. Okay, so on a self-directed IRA, who is the custodian? Well, in the case of Advanta, we are a custodian for self-directed IRAs. And remember that self-directed in and of itself is not an account type. It usually is meant to indicate that it's an IRA or other account type that can invest in alternative assets. And it is the custodian that you choose to have your money stationed with that is going to determine which assets you can invest in. So with Advanta, we service almost all alternative assets. There are some self-directed IRA providers who service some alternative assets, and then banks and brokerage houses usually are only publicly traded securities. So the custodian of your account determines usually what kind of assets it can invest in. Can I buy a primary home with an SD IRA? Unfortunately not. So the IRS does have some rules about your IRA, and a lot of those are based on the separation that I talked about in terms of your IRA's money and your personal money. So one of the prohibitions is that if my IRA buys an asset, in this case a single family residential home, I can't take use of it in the here and now. I can't personally live in it. I'm really not supposed to take any kind of use of it while my IRA owns it. My IRA could buy a home and rent it for several years, and then I could take a distribution of that home. And once it's 100% distributed to me, it's called an in-kind distribution. Once it's 100% distributed to me, then I could live in it, because it wouldn't be in the IRA anymore. It would be in my personal financial world. Then I could live in it. But no, in terms of Can you use your IRA money while it's in the IRA to purchase a home? The answer is no. Traditional and Roth IRA do have an exception to the 10% penalty, and you can take out a certain amount that won't be penalized, and that again is a distribution. So it's moving money from the IRA to your personal financial world. It's a much more limited basis. So the short answer to your question is no. The SD IRA cannot buy your primary home. Is there a tax advantage or disadvantage or legal implications to rolling a 401k into an IRA rollover? No. So the movement of funds via rollover from a 401k to an IRA is not taxed and it's not penalized. Now, there's a couple things to know about that. If your 401k is at a company where you are still employed, that plan may not allow you to actually make the rollover distribution. So rollovers can automatically occur if you are no longer employed there. So you do have that ability, and of course at 59.5 you can start taking distributions that aren't penalized as well. So you have some more flexibility in those two circumstances. But let's say that it is a 401k at a company where you no longer work, a rollover really is not taxed and it's not penalized. So understand that you can make that move without ramifications from an IRS perspective. Is there a tax advantage to contributing to a Roth 401k versus a 401k? Well, it really has to do with the tax status of the money. So if a 401k plan allows for Roth contributions, it is the employee deferral contributions that are being affected there, and they will have the same properties as a Roth. So post-tax money in, and then a qualified distribution will be tax-free. So is there a tax strategy there? Yes, I would say that it has to do with what you're going to invest that money in, and the tax advantage of a Roth versus what is essentially the 401k, the part of the 401k that is a traditional tax status. The advantage or disadvantage is what we talked about. So the tax event is at a different place, and so the tax event, depending upon the entire investment sequence, one might be better than the other. When filing taxes, I see an excise tax, very small, charged on the balance in the HSA account. Is this correct? No. So there should not be, so over contributions to these accounts sometimes do incur an excise tax. So the only time we really see excise tax is when there's over contribution. Typically it's 6%. But an HSA that is not, where you're not over contributing, would not have a tax associated with it, unless you have made a distribution that is not for a qualified medical expense. Can I defer my HSA expenses till after I retire? Yes. So I'll just tell you the sequence that I see sometimes is sometimes people who have an HSA will pay for all of their medical expenses out of their pocket, and they'll just hold the receipt, right? And you can collect those receipts for years or decades and still reimburse them decades later. As long as you have the receipt and can prove that it is a distribution that corresponds to a qualified medical expense, you could collect $20, $30, $100,000 worth of receipts from now until the time you retire. And if you have $100,000 in your HSA, you could redeem them all. In other words, take a distribution for all of them tax-free at one time, and it would all be tax-free, right? So tax-free distributions from an HSA only mean that it corresponds to a single qualified medical expense, and if you have not redeemed HSA money for a qualified medical expense, you can do that at any time. Is CPE given credit given for this seminar? Unfortunately not. That's a great question, but not in this case. I appreciate you asking them. Okay, so I do see some specific questions here that I did not answer right off the top. I'm going to actually respond to you via email because I want to make sure that I answer it in as specific a way as I can, and I will and not confuse everybody else. So I will, if I have not answered your question, I will respond to it via email specifically. And if you have other questions, go ahead and type them in real quick. But it looks like, yeah, we're after our hour. So again, if it's time for you to go about the rest of your day, thank you so much for spending some time with us. I hope this was helpful. Please do consider us a resource for any of your account questions. We're happy to help if we can. And so I'm going to hang on here for just a moment and see if any last questions come in. And but if not, again, thanks a lot for joining us today.